morning. You're listening to Insurance Matchmaking, your path to health, life, and Medicare coverage with Matt Libby Insurance. And now, sharing his knowledge, here's your host, Matt Libby.
Well, good morning. Welcome back to Insurance Matchmaking. Just a quick reminder, if you've never listened to the show before, we do this weekly. I am a local life and health insurance agent here in Cookeville. You can check us out at insurancematchmaking.com or go to mattlibbyinsurance.com. Either one, a good way to reach us. Normally, I'm usually talking about Medicare. That's probably kind of my sweet spot. I'm usually always talking about it. And I'm going to touch on it a little bit today. And I also do the under 65 health insurance, the healthcare marketplace, also known as Obamacare, the ACA, the federal facilitated marketplace, all of that. That all means the same thing. But we also do a lot of the marketplace alternative plans, too, for those that don't qualify for the income tax credit. And there's two ways you don't qualify on that. One is your income is above the limit, so they figure you can pay the exorbitant price because the only thing that makes the Affordable Care Act affordable is the subsidies. But the other thing is if you're extremely low income, you may not qualify either. You have to be at 100% of what the government designates as the poverty level. If you're below that, you would be qualified for Medicaid based on your income. That doesn't mean you're going to get Medicaid. Here in Tennessee, TennCare still has some restrictions, especially on young people that they figure are able-bodied and they're just poor because they're not working. They don't subsidize them. Certain health conditions and things like that will come into play. And I'm going down a rabbit hole here that I didn't mean to. But the reason I bring that up is generally, like I said, I'm usually talking about things that are health insurance related. And today I'm going to focus on life insurance, but from a health perspective. And again, I'm going to have to explain the plan a little bit, so it's going to be a little bit of dry information because it's going to be a lot of how the plan works. And it may not be until after the commercial break where I really tie it into why I am recommending this plan as a health insurance match. So as the title implies on this show, it's insurance matchmaking. We're here to match you with the right insurance, not just sell you a policy. So hopefully you'll get some of that today. And I debated on whether I wanted to say who the company is, and I don't want to really stress too much on the company, but they're the one that has this plan. I'm sure there's somebody else has a similar plan, but it is Mutual of Omaha. And so what we're doing is this. We're going to talk about this specific product, and kind of the subtitle here is your money really safe, and what do you get if you get sick? So that's kind of thing. Like I said, I'm going to tie it into health insurance. Like I said, that's going to probably fall into a little bit more after the break. As I said, it's a universal life. It's called Index Universal Life. And at the tag end of that, it says Universal Life Express. Just as we mentioned, the company, they are a mutual company. That means they answer to the policyholders, not stockholders. This is a permanent life insurance plan. It has flexible premiums. That's part of why they consider it universal life. It has cash value growth linked to an index, for example, the Standard & Poor's 500. But there are other indexes, whatever way you want to say it, out there rather than a fixed rate. And then the reason it's called Express is it has simplified underwriting. And that's why it's going to come into play again as a tool or a vehicle, whatever term you'd like to use, for health insurance reasons. Is you're not going to have to do a blood draw. Nobody has to come to your house and have you step on a scale and take your blood pressure, draw your blood, have you pee in a cup. There's none of that with this plan. We do have those plans. I actually had started this plan with a client, and we said, well, we can double check and see what we can get, fully underwritten, but you're going to have to do the blood draw and everything. Well, we did that and got like 3 times as much insurance for the same amount of money because she went through the underwriting. So if you're in really good health, this may not be the right plan for you. We could do a universal life, but not do this one. But this one's quick and easy. And again, some people like the quick and easy. I don't have to deal with a somebody call them vampires, somebody drawing your blood for the underwriting, what we call that a pyramid. And so this can be really simple. It's something we can do over the phone and boom, get your policy issued right away. So that's one of the reasons a lot of people like it. The other thing is this does deliver a tax-free death benefit because it's paid out as a death benefit. It is life insurance. So you can build the account and still pass it on to your beneficiaries, your heirs, and they don't have to pay tax on it. So there's a lot of reasons these plans come up. Sometimes we're looking at it as for a final expense insurance. It's similar to those. This one is not a whole life or a whole life plan. You set that premium and that's there. So that's one of the things. It does help on that. And like I said, it is insurance, so it can be tax-free. And the reason I'm talking about, even though maybe, you're paying more than you would have on another policy, you're still not losing money because basically you're paying in and you're paying for insurance. There's going to be a cost of insurance come out of it, but you can also build the cash value of the plan. So depending on how you market that. And that's why one of the reasons why, again, we talk about doing annual reviews to make sure that you are paying enough premium. And there's also, you can pay more than a certain premium. There'll be a cap on how much you can put in, because if you put too much in, it becomes what they call a modified endowment, and then it is taxable. So you have to be careful not to put too much money into the policy, or it is what they call a modified endowment contract is what they call it. It's no longer a life insurance contract. So you have to be careful not to put too much money in it. But we always recommend that, hey, even if it maybe says here's the minimum premium, that minimum premium is just to keep the life insurance policy in effect. Always recommend you round it up, or there'll be a target premium and then there'll be a maximum premium. We recommend you pay somewhere between the target and the maximum, but it will be enforced if you pay the minimum premium. But the death benefit can be reduced over the years, and we'll go into that in a little bit. I got a little bit ahead of myself. So the big thing is with the index plan is it has a 0% floor, and that means you don't lose money on the plan on what the financial part of it. It uses what's called annual point-to-point crediting, and the index value is measured against a segment, and then 1 year later, the percent change. And of course, that is subject to a cap, but to a cap and participation rate, but it's as credited as interest. And then you get, the thing is, so the floor is 0%. So the beauty there is, and I use the example of the Standard & Poor's 500. If it's tied to that index, and that index loses 20%, it's not like a mutual fund where your mutual fund just decreased 20%. This does not decrease, it just doesn't get anything added to it. So there is that. And the beauty there is also the money is never directly invested in the market. It just uses the performance of that index to credit the interest. And then there are what we call, the riders. You can have the fixed account option where a guaranteed minimum of 2%, crediting 2%. So even if it would be a 0 year, you could get 2% interest on it. And regardless of the index performance. So that's a good deal there. And caps in participation rates, you move the money with the economic environment, but will never fall below the guaranteed minimum levels in the contract. The other thing is you have a no-lapse guarantee, and that's why I was talking about that minimum premium. As long as you pay that required minimum premium, the death benefit is guaranteed. Now, this plan works a little different than, again, not like a whole life plan where you pay the premium and it's always going to be that certain death benefit. And when we talk about whole life plans will gain, and sometimes that payout can be more than the guaranteed death benefit. With a index plan, with a final expense plan, it's always going to be, if you get a $10,000 final expense plan, it's still going to be $10,000, whether it's 5 years later, 10 years later, 20 years later, because that plan is calculated to cap that you would reach the max amount if you live to 120. So that's how they can lock in your premium. Never goes up. Death benefit never goes down. With the index plan, once you pass the guarantee period, if you haven't been funding it well enough, it will start eating at the value to pay the insurance costs. So your death benefit could be reduced depending on how much of your cash value you're using. If you get the policy from age 18 to age 60, it is guaranteed for 20 years. Age 61 and up, it is guaranteed to age 80. So if you haven't picked up a universal plan and you want to make sure you pretty much have a guaranteed death benefit, if you're over 60, you know it's going to at least go to age 80 before you're losing any of the death benefit. So that can come into play. Because again, a lot of times when I'm talking to people is those that are hitting the Medicare age. And so that's a lot of times that's when these final expense conversations come up. And one of the reasons I bring this up in the final expense realm is now this plan is very easy to get underwritten, just like most of the final expense plans. It does have a minimum death benefit. You have to go at least $25,000, whereas with a final expense plan, most of those plans are $30,000 to $35,000. There's a couple out there maybe that go up to $50,000 as a death benefit, which would be very expensive when you're in your 60s. But some of them will go down even as low as $2,000. To at least you have that guarantee to have that amount in place to cover some final expenses. Some people will go as low as $5,000. Most people don't get those. Usually people are getting $10,000 to $12,000 to $15,000 on those plans. This plan, it has the minimum is $25,000. Now the beauty of that $25,000, I think generally when I price it against a final expense, I think it's like right at about 15. So like 15,000 on a whole life, or 25,000 on the index universal life, and your premium is about the same. So it does stretch a little further, and so that's how that works on the premiums. And you can go it's up to 550,000, I think it is. I didn't have that number in front of me. And then again, that's dependent on age. If you're over a certain age, it's like 300,000 is the max for like somebody in their 60s, where somebody 40 could get over 500,000 on this policy because they are expecting you to live longer, so they'll let you get a higher death benefit. So there is, as I mentioned, there is a standard disclosure. It's not FDIC insured. It's not a bank deposit. It may lose relative value if underfunded, but the floor protects principal from market loss specifically. And then also the insurance company has their AM Best, Moody's, Standard & Poor's ratings, so you can be pretty self-assured that you're not going to lose money on this account just based on the past history of the company. There is what's called a lapse guard rider, and it's built-in issue. It's not an extra cost, and I don't know if maybe I need to explain. A rider is just something else that's added to the plan. A lot of times your riders are going to be something that you purchase to add on to the policy, so it adds a little bit of a cost. You can have things like inflation protection riders. You can have an accidental death benefit rider, things like that generally will be charged. We're going to talk about some riders again, like I said, after the break, and it looks like we're at that time. So after the break, I will branch into more on the riders and how this applies in the health insurance realm.
Why pay two companies when one will do? Bundling is better. Pair Twin Lakes Gig Speed Fiber Internet with Tri-Lite Mobile, and your first wireless line is free for a year. Internet plans start at just $34.99 a month. That's blazing internet at home, nationwide 5G wireless on the go, and one friendly local team taking care of it all. Two great services, one great company. Visit twinlakes.net or call 800-644-8582. Twin Lakes and Tri-Lite Mobile. Bundle better. Terms and conditions apply. See twinlakes.net.
Join Habitat Restore at their pop-up donation event every second Saturday of each month at First National Bank in Sparta. The Habitat team will be there ready to go to receive your donations. So don't miss an opportunity to declutter and make a difference at First National Bank in Sparta with the Habitat Restore pop-up donation event every second Saturday of the month.
And now, back to Insurance Matchmaking with Matt Libby Insurance.
All right, we're back. As I mentioned, we were talking about this Index Universal Life Express plan, and wanted to get into, was talking about the riders, and we were talking about just before the break, the lapse guard rider. And I'm just going to read this. I think it's going to be, instead of me trying to explain it or maybe explain it, there is a trade-off. Let me start at the beginning. The lapse guard rider is built in at issue, no extra cost, prevents an overfunded policy taking level withdrawals from lapsing during retirement, protects against an unexpected taxable event on loans. The trade-off is the accumulation value is reduced 3% when exercised. With the index strategy, there's the floor is zero. With the fixed account, you're guaranteed at least 2%, and the death benefit has a contractual guarantee window built around it. That's 3 separate layers of protection stacked on top of each other. And then now we're going to talk about the living benefit riders, and that's what I wanted to address. I said that here after the break in the second half of the show, why I'm talking about this life insurance plan from a health perspective. One of the things, if you've been listening to my show recently, you've heard me talk about the umbrella coverage. We talk about the recovery care, the skilled nursing plans, and or the chronic, the big 3, cancer, heart attack, stroke, those plans that will protect you against those non-Medicare approved expenses. Well, this can also fit some of those issues. And the thing is with this plan is sometimes your health is not perfect. So some of the plans I talked about that fit in the umbrella coverage don't fit because of you could be turned down for a certain thing, where with this Universal Life Express plan might be approved even with that pre-existing condition you have, because it's not insuring your health. It's insuring against your death, but it's not insuring your health. So you may be able to get this and not have those, what am I trying to say? Those elimination periods, those waiting periods for pre-existing conditions. So the other thing is, it is a life insurance policy. So if you pass away and don't use the benefits of this plan, you have something to pass on to your heirs, to your beneficiaries. But we talk about the death benefit. A lot of people say life insurance is not life insurance, it's death insurance, because a death benefit only helps your family. So that's where we're talking about these riders, these living benefit riders. So, and the neat thing with this plan, there's no charge for these riders. This is something just part of the plan. This is where it really fits in with the health insurance coverage part, or that, I hesitate to use the word long-term care, but it will fit into some of those long-term care expenses. We have those short-term health plans that cover some of the same kind of things. And this plan will kick in, the benefits will kick in just like with those skilled nursing, recovery care, home health care plans, that the activities of daily living or that cognitive memory diagnosis. So those are some things that this plan will help. So the first one we talk about is a terminal illness rider. It's automatic. Again, I said it's automatic. No additional cost for this rider to be on part of the plan. And to be considered terminal, your life expectancy has to be 12 months or less. And at that point, you can accelerate 80% of the death benefit to your plan. So, and just I'm going to use the example of $100,000, so it'll keep the math simple. Now there's going to be some fees and things, so you won't necessarily get the full $80,000. In fact, it does the example here for me. But what there will be is $20,000 left for the death benefit. So you do still have your final expenses covered, but you had something to also protect for your health issues in the meantime. So using that $100,000 example, you request $80,000 be accelerated. It's going to be reduced by what they call an actuarial adjustment plus $100 administration fee. So it could be roughly $75,900 of net benefit paid. But you, like I said, you still have that $20,000 left over to still pay out as a death benefit. The next rider that's still in this, and it fits in kind of the same category, is the chronic illness rider. It's automatic. There's no premium for that. And it triggers, as we say, when you can't perform 2 of the 6 activities of daily living, or as we usually say, ADLs. And you're living for 90. Now, there is, if it doesn't start immediately, but you can't perform those for 90 consecutive days, or you have severe cognitive impairment requiring substantial supervision, and it's physician certified. So it just basically takes a letter from your doctor saying that you have this condition, or you're not able to do the activities of daily living. It does not require nursing home confinement. And that's a big deal there. We talk about the recovery care plan. That one there's going to cover skilled nursing confinement. The home health plans, some of those will pay for nursing home, but they also pay for the home. This one here is you can use it at home, you can use it in assisted living or in a nursing home facility, and you still have that. You can claim that 80% of the plan to cover those expenses, which can be, $100,000 or more a year. So this could come in very handy. And then, as I say, the notice, this rider costs you nothing until you need it. If you never get sick, you never pay for it. And that's also a form of financial safety, because you do still have that plan. You still have the opportunity. You can take loans against this account. It does have I believe there's, and it's not saying here, okay, here is the surrender value. I'll get into that. So the critical illness rider, it's automatic, no extra cost. So we talked about the chronic illness. We talked about terminal illness. We talked about how this you can be used for a nursing home, but it doesn't require you to be in a nursing home. The critical illness, again, no extra cost. It covers a defined list: ALS, kidney failure, a life-threatening cancer, more major organ failure. A lot of times health conditions come up, you end up with having kidney failure, so this is something that would cover a heart attack or a stroke. Dementia, of course, that includes Alzheimer's. We talked about the severe cognitive impairment. Major burns, and that's not the one on MASH. This is talking about actually like third-degree burns. I lost my place being funny there. And or if you have aortic aneurysm surgery. So there's a lot of things that this plan would kick in and pay out without you having to pass away. Again, waiver of surrender for partial withdrawals, penalty-free partial withdrawals if hospitalized, confined to a nursing home, or unemployed and receiving unemployment benefits for at least 60 days. So there are ways to draw money out of this account. It's not just tied up in the policy. So there's a lot of things that this can be a good value for you to use. Every one of these riders I mentioned, the terminal, the chronic, the critical illness, and the withdrawal waiver, those all come automatically with the policy at no extra charge. So, who does this fit? Your principal is protected from market loss with the 0% floor. You can have that minimum guaranteed crediting rate, and you can have that. You have the contractual no lapse guarantee on the death benefit, and then the 3 living benefit riders that are included at no charge. So if you want permanent coverage, no market risk, again, one of the things we talk about, when you have money in the stock market, there's always that risk of loss. And then you have access if you're diagnosed with some type of severe or chronic condition. So it does have uncapped growth potential. We could look at, also plans that will include a long-term care rider that this plan doesn't. But just kind of wanted to say, this was the breakdown of this Index Universal Life Express. We can do actually pretty quick quotes on it. I can do the quotes on my phone. I just put in your age, male or female, and how much coverage you want, and it'll tell us. Now, what it's going to do in that quote is it's going to tell us what the minimum premium is. So, but that'll show you kind of the affordability. But as I said, the minimum premium really isn't what you want to put in. So call us with your questions. Again, go to insurancematchmaking.com. There's a spot for comments and questions. You just let us know, hey, I want you to, can you address this on a future show? Or can you reach out to me directly? I've got this question, because especially if it's personal. Now, I may take your question and share it here on the radio, but I will definitely, kind of disguise it so people shouldn't be able to tell who I'm talking about unless your business is all out there in the news and the newspapers and Facebook. If I'm describing your issue, you shouldn't be recognized. But I do like to use real life examples. One of the things I was thinking about this morning, that I had worked with a couple, and he was concerned about the cancer coverage because his wife had cancer previously, and so I was able to get them both insured, and ended up about a year after I wrote him that policy, he had a severe cancer and hospitalized and everything. Doing great today. And that $30,000 cancer plan for him came in very handy for all the different expenses that they incurred with his cancer care. So, like I said, I like to be able to use real life examples. So if you've got an example, or especially, hey, if I've helped you with something and you'd like to share that. Now that I probably, if you don't mind, share it in a review on my Google or Facebook. But also, you can share it and say, because sometimes I have some of these situations come up with a client, and I didn't realize they just handled claims themselves or whatever, and are doing well. Or even if it wasn't something I helped you with, but you can let me share it as a good example of how it helps you, please do. So anyway, until next week, keep it tuned here at Grace 107.7, and tune in Saturdays at 10 to Insurance Matchmaking. And remember, we are right here in Cookeville. We are a local company. Please don't just call an 800 number. I don't care if you go to another agent and get advice, but at least if you're going to do that, talk to another local agent, not somebody across the country. And have a great weekend, and we will talk to you again next week.
You've been listening to Insurance Matchmaking with Matt Libby, your path to health, life, and Medicare coverage with Matt Libby Insurance.